Welcome to the Ask Chris Real Estate Podcast with Chris Phillips from Keller Williams. A successful 20-year veteran in the Middle Tennessee real estate market with over 100 five-star reviews, Chris is known for his knowledge and integrity. Whether you're buying, selling, investing, or just curious, his insight will guide you along the way.
Hello guys, welcome to my podcast, and today we're going to be talking about choosing the right loan for you. This is one of my favorite things to do as a real estate agent, and the reason I love this is because most agents just kind of put this on the back burner and let the loan officer do this, which I do, and because they are the expert. But I want to know the information so that I can hold my loan officers accountable to the different types of loans that are available and talk to my buyer so that I can talk in layman terms, because sometimes when the buyer is talking to the loan officer, things are lost in translation. So I'm able to convey to that buyer in layman terms what their options are, and we're going to kind of get into that today, and we're going to talk about, what kind of loan's right for you. But before we do that, there's some questions you need to ask yourself is, like, how long are you going to be staying in this home? And I know that sounds really strange, like, well, why does that matter when I'm picking the loan to purchase a house? Well, certain loans can work better for you or provide better terms for you based on the time period you're going to be in the home. Also, what's your credit score and your income stability? Because certain loans require certain incomes and we're not talking max like what you've got to make, but you have to be under a certain income. So like with USDA loans, you can't make over $75,000 or, and I'm making that number up. I don't know that number off my hand. I could look at the USDA website, but there's certain loan qualifications or income qualifications to qualify for a loan. And how much can you put down? That also determines which type of loan might work best for you. If you're a veteran and you're just coming home from working abroad, you might have a buttload of cash that you've gotten from your bonus, and you don't want to put that down because you want that as your nest egg. So you might do a VA loan, which is 100% financing, and we're going to talk about what happens with that. And then the last one is picking the right loan officer for you to purchase this deal. And I'm going to tell you, this is crucial. There's a lot of loan officers out there that are great. There's also a lot of loan officers that just treat you like a number, and it's like next one up. So you want one that's going to explain to you why she or he thinks that loan that they're suggesting that you use to purchase a certain house goes with it. So let's dive into it. So the first one's FHA, and this is a government-backed loan. It's backed by the Federal Housing Administration. It's ideal for first-time home buyers. In fact, Kelly and I took advantage of the FHA loan. The first house that we bought, we put 3.5% down. We bought a house for $100,000, believe it or not. I mean, that was ages ago. Now almost 24 years ago. And so we had to put 3.5% down. So that means we had to come up with basically $3,500 for the down payment, and that did not include our closing cost. So that's important. There's an extra cost there that you're going to have to account for, and we were able to roll that closing cost into our loan or our purchase, and that was a time that we could do that. And the industry has changed, and sometimes those are not able to be rolled in, but sometimes you can. This credit score is usually a 620 or above. It requires some upfront and monthly mortgage insurance, or PMI, and a PMI is basically insurance that you're paying to the bank or the mortgage company to ensure that if you default on this, that their investment is going to be covered. And that's what the PMI is, because you're not putting 20% down, so they have more risk. So because of that, you have to pay a higher mortgage insurance, which is got to be calculated into your payment, which also will affect how much of a house you can buy. So FHA could limit how much you could actually qualify for. The next one's a VA loan. This is a military advantage, and it's available to veterans, active duty military, and eligible surviving spouses. You can do zero down with this. You can do no mortgage insurance with this. However, there is a $5,000 funding fee for this with VAs. That's usually done on the upfront, and they'll roll that into the mortgage itself. However, that can be waived if the veteran is disabled or has a certain percentage of disability, so that fee can be waived. The VA funding fee may apply, but it will most likely be rolled into the loan. And then you have USDA loans, which we can use here in Tennessee. And when I say USDA loans, most people think of farm loans. That's not what we're talking about. We're talking about rural areas that are being populated that qualify for USDA loans. These loans are backed by the U.S. Department of Agriculture. They're 100% financing, and they require no down payment. The thing I love about the USDA loans is this enables someone who usually is an FHA person, and they can use that 3.5% towards their closing cost, or they can use it to pay more upfront fees so that they can avoid some other fees that with FHA that they wouldn't have with USDA. You must meet the income qualifications as well as the geographic requirements. How do you know if a house qualifies for USDA loan? You can actually go to the USDA website, put that address in, and it'll tell you if it qualifies for that. So there's two qualifications there. The buyer has to qualify based on their income, and the property has to qualify. So those are two important things. And believe it or not, here in Tennessee, we still have USDA loans that are in the local area. They're just right outside of city limits that you could qualify for this. And then the last one is conventional. Now, lately, guys, people have been getting really creative with these conventional loans, and these are traditional routes. This is where they're not backed by the government. It's a private lender that's Fannie Mae or Freddie Mac standards. It's usually anywhere from 3 to 5% down, but it goes up to 20% down. So when I tell a buyer, like, hey, let's do a conventional loan, you can save some money on PMI, they're like, well, I've got to have 20% down. Well, no, not always. Some conventional loans can do 3 or 5% down with a strong credit score. So if you've got a strong credit score in the 700 pluses, then you would be able to qualify for this, and that's going to help you. And that's going to also lower your PMI because it's going to be based on, well, this person's credit worthy. They've got credit. They've got a strong payment history. So they're more apt to do it, and that's why this conventional loan would work. However, most of us, when we get into conventional, we're putting 20% down, which eliminates the PMI, which is what you want to do. You want to get rid of that PMI. That's money that's just wasted and goes away. It's a necessary evil when you first start out, but the faster you can get to getting rid of the PMI, the better off you are, and the more you're going to be able to buy into the principal and get it down faster. And here's one that I never thought that I would do, that I did personally. When my first home that I bought, when my wife and I, Kelly, wanted to upgrade into our second home, it was an FHA loan. And I could not have 2 FHA loans because I had a first FHA loan, but I did not want to sell my first property because I wanted to turn it into a rental. And I had just started in the real estate business. I didn't have a lot of, I didn't have 2 years of income history, so that was difficult to cross that hurdle. So I couldn't qualify for a conventional loan. So what I did is I did a fixed adjustable rate. So what I did is I went to my credit union that I belong to, and I got a 5-year ARM. Now that sounds dangerous, and most people who are very conservative, when they hear a 5-year ARM, they're scared to death because it comes due in 5 years. But my number one objective was just to get us into this house and then turn around and rent out my first home so I could make it a rental property, and then later on refinance after I had a 2 full years history of working in the real estate industry. so I could show that income as a self-employed person. So that's how I bridged that gap to get me to that conventional loan. And 3 years later, I refinanced out of that ARM. I got a better interest rate. I got a 15-year loan, and I was able to get rid of the ARM. That can be dangerous for two reasons with the ARM, and I want to emphasize this. If you have a volatile income and you're not as stable as far as that goes and being able to make your payments, and you're worried about income, do not do the ARM. And the reason why is, think about it. If I miss a couple of payments or I mess up with my credit score, I'm not going to qualify for that conventional loan. So that ARM is going to come due, and then it's going to be harder for me to refinance down the road. So you've got to be really cautious in how you use this vehicle when it comes to purchasing a house. But it can be a good tool for you, and it was perfect for me to get me to the conventional side. And once we did that, we refinanced the rental property, refinanced our house, and we got great rates, and we were off to the races in the world of real estate investing. So guys, those are your loan options that you have when you're going to purchase a house. Just keep in mind, each one of those have different unique things that will be taken into consideration for those to work for you based on what your scenario is and you're working for. And get with your loan officer. They're great at doing that. And the industry of lending, guys, is the most creative industry as far as finding a way to give you money. That's how they make money. So they don't like turning people down. So they're constantly tinkering with these things. So while this podcast is good for now, these terms could change in the next 6 months. So if they do, we'll keep you updated with that, and we'll come back and give you the new updates for those terms on those loans. If you have any questions, just reach out to me below, and we look forward to hearing you on the next episode.
For answers to all your real estate questions, ask Chris at the Phillips Group, Murfreesboro, Tennessee.